So welcome back. So in the next lecture of public finance, in the previous lecture of public finance under the budget, we discussed the types of budget. We discussed zero-based budgeting, then performance budgeting, and then outcome-based budgeting, gender budgeting. Then afterwards we discussed the budget of the states, and then we discussed how the plan versus non-plan, revenue versus capital, and development versus non-development expenditure. So all these things we have already discussed. So the next topic under public finance will be taxation. This is one of the most confusing as well as one of the most technical topic from the perspective of exam, because taxation is always a little bit of confusing one, because most of you are not from economics background. So in that case, students, sometimes they have phobia with this taxation. What is corporate income tax? What is personal income tax? What is surcharge? What is cess? What is excise duty? What is custom duty? All these things. So I tried to frame this unit in a conceptual manner. I related few concepts like what is direct tax, what is indirect tax, what is the tax levied by union government, what are the taxes levied by the state government. And then, because sometimes in exam the question comes, which of the following taxes are levied by union government, and sometimes it comes, which of the following taxes they are direct taxes, they are indirect taxes or something. So try to club together these things. But before coming to this topic, first let me tell you, let's discuss some few definitions which are related to taxation. So first of all, I want to discuss what is tax. So tax is nothing but it is a compulsory amount of money which you have to give to the government without any quid pro quo. Quid pro quo means nothing in return. You are paying something to the government. Suppose your income is 10 lakh rupees, you have to pay a certain amount of personal income tax to the government, but you can't expect that 10 lakh rupees should be invested by the government, maybe to make some road, or maybe to make some power project or some other project. You cannot dictate these terms to the government. So taxation is nothing but it is a compulsory payment to the government without any quid pro quo. This is what we have, taxation. And in next class we will discuss the different types of articles which are related to taxation. And the fiscal federalism chapter, we are going to discuss the different type of taxes, center state finance relations we have. It starts from article 265. So the definition of taxation is defined in article 265, which also says no taxation without representation, or in other words, there cannot be any tax which can be levied without the authority of law. So if the parliament decides or if the state government decides, they can levy some taxes, but arbitrariness should not be there while you are paying the taxes. So it should be only be decided by the authority of law. So this is what we have, the definition of taxation. Then we have few related definitions, like what is fiscal marksmanship. Often in the newspaper these terms come. The fiscal space of union government has decreased. There is a consolidation phase being started by the union government. So first we will discuss what is fiscal marksmanship. Marksmanship is nothing but what is the target that you have decided. Suppose in the budget we decide that for next financial year our revenue deficit will be this much, our budget deficit will be this much. The details of these individual targets will be discussed in that contemporary units, the last 2 or 3 units of this economics, under which we will cover the budget of 2016-17 and the economic survey of 2016-17. There we will discuss the specific targets. But suppose the fiscal deficit target of 2016 and 17 is 3.5%. And once this 2016 and 17 will be finished, then you have to evaluate it whether the government or we were able to achieve this 3.5%, or we have achieved more than 3.5 or less than 3.5%. So whatever targets we have set, if we are able to fulfill these targets, then our marksmanship is good, and if we are not able to fulfill our targets, it means our marksmanship is bad. So fiscal marksmanship means whatever the targets or the objectives set by the government, If the government is able to achieve these targets, then the fiscal marksmanship of the government is good. Otherwise, the fiscal marksmanship of the government is not good. This is what the marksmanship means. Then we have the fiscal consolidation. The fiscal consolidation means, we have already discussed that there is a fiscal deficit in India, and that fiscal deficit is roughly equivalent to last year it was 3.9%, or in actual terms it was roughly 5 lakh crores. Roughly it is 5 lakh crore. So 5 lakh crore we have to borrow. Fiscal consolidation means you have to consolidate something. Consolidate what? You have to consolidate your expenditure. If my expenditure is more and my receipt is less, then the option is I have to borrow from the market. And fiscal consolidation means you have to rationalize your expenditure. So consolidation means nothing but you have to decrease your expenditure. Now how you can decrease it? So the means, the tools which the government is going to adopt to implement this fiscal consolidation can be different. For example, during UPA time, the government decided that no government meetings will be held in 5-star hotels. So through that, by not allowing the bureaucrats and the politicians to take their meetings in a 5-star hotel, the government has decreased the expenditure. So these are the tools through which the government can achieve this fiscal consolidation. But consolidation in simple words means the government should decrease or rationalize their expenditure. This is what the fiscal consolidation means. Then we have the fiscal space. Fiscal space means, suppose this is the money being collected by union government. For example, the total tax collected by union government is 15 lakh crores. But out of this 15 lakh crore, the union government has to pay 5 lakh crore to the states. Now before the recommendations of 14th Finance Commission, it was only 32% of this 15 lakh crore which the government was supposed to devolve to the states. Once the recommendations of 14th Finance Commission has been accepted, now it is 42%. Maybe in next lecture or next to next lecture we will discuss the recommendations of 14th Finance Commission. So once the recommendations of 14th Finance Commission has been accepted, now the fiscal space available with the union government has decreased, and the fiscal space available with the states, it has increased. So space is nothing but the amount of money, the amount of tax which is available with that particular government. So this is what we have, the fiscal space. So in the newspaper it often comes that by accepting the recommendations of the Finance Commission, the fiscal space available with the union government has decreased. So this is what we have, fiscal space means. And then we have one more term that is known as buoyancy. Usually it comes in the newspaper that this tax is buoyant, this tax is not buoyant. Buoyancy means a tax will be regarded, can be regarded as buoyant if the increase in GDP is 1%, leads to increase in the tax by more than 1%. Then only we will say that this particular tax is buoyant. In other words, it means when I am saying the GDP is increasing, so when the GDP will increase, what is GDP? GDP is nothing but the money value of all the goods and services produced in any economy in one financial year. Suppose this is India, and in this India we are producing 1 lakh items. 1 lakh items which includes maybe this 50 pen, 50 markers, 50 registers, 50 tables and all these things, 50 laptops. So after adding all these items, it makes 1 lakh items. So whatever is the money value of all these items which are being produced in this economy in one financial year, that is known as the GDP. When I am saying the GDP is increasing, so when the GDP is increasing, so the money available with the public is increasing, as well as the tax of the government is also increasing. Because if your income increases maybe from 5 lakhs to 10 lakhs, because the GDP is increasing, so it means the money is increasing. So somebody is getting more money. So suppose your income increases from 5 lakh rupees to 10 lakh rupees. So now you have to pay more tax to the government. So the personal income tax will be buoyant in this case. So buoyancy means if the increase in GDP is 1%, if that particular tax collection is more than 1%, then that tax is known as buoyant. I want to take some example. For example, we'll discuss in detail in this PIT. Up to 2.5 lakh rupees, you don't have to pay any tax. So suppose your income is 5 lakh rupees. On this 5 lakh rupees, up to 2.5, you don't have to pay any tax. For rest of the 2.5 lakh rupees, you have to pay tax at the rate of 10%. So 25,000 rupees is your tax liability. But suppose the GDP increases and your income becomes 10 lakh rupees. So now up to 5 lakh rupees you have to pay this 25,000, and for rest of the remaining, the increased 5 lakh rupees, that comes to slab number 2. Details we'll discuss here. So now this will come under slab 2, and here you have to pay 20% of 5 lakhs, which equals to 1 lakh rupees. So now your tax liability becomes 1,25,000 rupees. So if the increase in GDP is by 1%, the increase in tax collection of the government is more than 1%. So this is known as buoyant taxes means. This is known as the tax buoyancy means. These are the few definitions which are related to taxation. Next we have different types of taxes. We can classify the taxes on the basis of different things. First classification is on the basis of tax rates. So on the basis of tax rates, we can classify taxes into progressive, then we can have proportional, regressive and digressive. So this is the first classification. This is the first type of tax, and this classification is on the basis of tax rates. So first, progressive tax. So progressive tax is nothing but when your income increases. Suppose this is what your net income, and this is the tax rate. So when your income increases, the tax rate increases. This is known as progressive tax. So the progressive tax is based on the ability to pay. When your income is increasing, your ability to pay taxes is increasing, because now you have more money in your hand. So this progressive taxes, they are based on the ability to pay. So when your income is going to increase, the tax rate is going to increase. For example, up to 5 lakh rupees, it is just 10% in case of personal income tax. Then 5 lakh to 10 lakh rupees, it is 20%, and above 10 lakh rupees, it is 30%. So this, the example of progressive tax is personal income tax. And these progressive taxes are good because they decreases the vertical and horizontal inequality. Suppose one person is having the salary of 1 crore rupees and second person is having the salary of 10 lakh rupees. So both should not pay same amount of tax, because this person whose salary is 1 crore rupees is having more ability to pay. So the government should charge more tax from this 1 crore and less tax from a person whose salary is 10 lakh rupees. And if more tax will be charged from this guy and less tax will be charged from this guy, the horizontal inequality across the society will decrease. So progressive taxes are good for any economy. Then after this progressive taxes, next we have is proportional tax. Proportional tax means the tax is fixed. It is a certain percentage of your income. The example is corporate income tax. So corporate income tax is fixed. For Indian firms it is 30%, for example. So whatever your income is, for example, we have a big company like Infosys, and we can have a small MSME, a small company is there, and suppose the profit of Infosys is 5,000 crore and the profit of this MSME is just 10 crore, but both have to pay 30% of their profit. It means proportional tax is certain specified proportion of your income. So this type of tax or the proportional tax does not quantify the horizontal inequality of the society, but the progressive tax, it decreases the horizontal inequality. So the graph of proportional tax will be, suppose this is income and this is tax rate. So whether it will be parallel to x-axis or parallel to y-axis. So obviously it will be parallel to x-axis. It will be like this. Fixed 30% is the tax rate. Whatever your income is, the tax rate is fixed, that is 30% in case of Indian firms. Then we have the regressive taxes. So regressive word is having two meanings. First is it is a type of tax, and second one is a general word which means regressive. So regressive is just the opposite of progressive, which says if your income increases, the tax rate decreases. So it will be like this. Can you tell me any example of regressive tax in the present society? So as such, there is no example of any regressive tax because it's not possible. It is as if like a poor person whose income is just 2 lakh rupees has to pay 70% tax, and a rich folk having salary of 20 crore rupees has to pay just 10% of tax. So it is not possible. Before French Revolution, a very similar type of tax was there in France. But now in the present day society, on the present century, there is no such tax like regressive tax. But yeah, we can say few taxes are regressive. That regressive is different. The meaning of regressive is which affects the poor most. So maybe some indirect taxes are there, we will discuss later on. Let's suppose everybody, I want to buy this marker. So there can be two customers, a person whose income is 2 lakh rupees and a person whose income is 20 crore rupees. So both have to pay the same amount of indirect tax, the same excise duty they have to pay. That is why we say the indirect taxes are regressive, because for a person whose income is 20 crore rupees, maybe if the government increase the tax from 10 rupees to 20 rupees, so 10 to 20 is not a problem for this person, but maybe this increase of excise duty from 10 rupees to 20 rupees can be a problem for person A. So that is why we say indirect taxes are regressive, but indirect taxes are not example of regressive taxes. Make this thing very clear in your mind that as per this classification, there is no example of any regressive taxes in present day society. Then the last type of tax on the basis of tax rate is digressive taxes. So digressive is nothing but it is a type of progressive tax only, under which the tax rate increases up to a certain level and then it becomes constant. This is very much the example of personal income tax, where when it is 10%, then it is 20%, and at 30% of tax rate it becomes constant. So it means if your income is 20 lakhs or 30 lakhs or 40 lakhs or 50, 60, whatever your income is, after this slab of 30% it is constant. So such type of taxes, they are regarded as digressive taxes. So personal income tax is an example of digressive tax. So this is what the first classification of the taxes. Now the second classification of taxes is on the basis of shifting of tax burden. So most of you must have heard this direct and indirect taxes. So on the basis of shifting of tax burden, shifting of tax burden means the impact and incidence of tax. Impact means point or a person to whom this tax has been applicable, and the incidence means the final burden. Let's discuss this thing with an example. Suppose your income is 5 lakh rupees. So you have to pay some tax to the government. You cannot tell your friend that my income is 5 lakh rupees. Please pay some tax to the government on this my income of 5 lakh rupees. The impact, the tax is being should be paid, or it is the point of impact is A only, and the incidence, the final burden has to be borne by A only. It cannot be shifted. But this is not the case in case of indirect taxes. In case of indirect taxes, for example, it is excise duty. So what excise duty means, we'll discuss in detail here. Excise duty is nothing but whatever you are producing, whatever is being produced in any country, so on that production only you have to pay some tax. So whenever a company is, this Camlin is making this pen, so they have to pay some tax to the government. But whatever tax they are paying, suppose the price of the raw material will be involved, this plastic, ink and all. So suppose the price of raw material is 15 rupees. Now excise duty they have to pay, and the excise duty is 10 rupees. Then sales tax and all this thing, forget about that. So it becomes 25 rupees. So this 10 rupees, the impact of this tax is on this company who is making this pen, this Camlin company. But the burden will be, the burden of this tax will be borne by the person A who is going to purchase this particular marker, because the MRP will be, MRP includes the price of the raw material as well as the commissions, omissions, as well as the tax. So the impact of this tax is on this company, but the incidence, the final burden is being borne by this person A. But in case of direct taxes, it is not possible, because in case of direct taxes, the impact and incidence is on the same person. If your income is 5 lakh rupees, you have to pay this tax. If this company's income is 10 lakh rupees, so this company has to pay this tax on this thing. So this is what the definition of direct taxes and indirect taxes. In case of direct taxes, the impact and incidence is on the same person, and in case of indirect taxes, the impact and incidence may be or may not be same, so it can be shifted. The simple definition of direct taxes is nothing but it is on the income and expenditure of individuals and firms. And the indirect taxes is, it is on the sale and purchase of commodities and services. So whatever the total income of anybody or the total expenditure, so the example of expenditure we'll discuss under this Fringe Benefit Tax or Dividend Distribution Tax. Suppose I am a company, whatever is my income, suppose the income of a company is 10 crore rupees. So on that income I have to pay some tax. So direct taxes, they are on the income or expenditure of individuals or firms. And in case of indirect taxes, it is on the sale or sale, purchase, or we can say production and distribution. It is on the production and distribution of commodities and services. So indirect taxes, they are being levied on production. You are making this pen. So while you are producing this pen, you have to pay some tax, that is on as excise duty, or on the distribution stage. So while distributing, you have to pay some sales tax and all these things. So that is what we have, the indirect taxes. And the next one is, here we can see it is based on the ability to pay. So it means direct taxes are progressive in nature, and indirect taxes, because everybody has to earn the same tax. If the excise duty is 10 rupees on this particular pen, so everybody, whether your income is 5 lakh rupees or 50 lakh rupees or 50 crore rupees, you have to pay same 10 rupees while you are buying this particular pen. So indirect taxes, they does not distinguish between rich and poor. Everybody has to bear the same amount of burden. That is why indirect taxes, they are regarded as regressive in nature. Sometimes in the newspaper it comes that indirect taxes are regressive taxes. So that does not mean that indirect taxes qualifies into the example of regressive taxes. No. And in present society, no example of regressive taxes. Indirect taxes are only regressive in nature, not an example of regressive taxes. In detail, we'll discuss this direct and indirect taxes here. Then we have the imposition. On the basis of imposition of indirect taxes, again we classify the taxes into two parts: ad valorem taxes and specific tax. Under this ad valorem taxes and specific taxes, it is based on the certain percentage of output. Suppose you visited any restaurant, and in that restaurant, if you have consumed food of 1000 rupees, or if you have consumed a food of 5000 rupees, you have to pay the amount of tax, the service tax, that will be certain percentage of the final output. It means, for example, the service tax is 15%. So in this case you have to pay 150 rupees, and in this case you have to pay 750 rupees, because service tax is an example of ad valorem tax. So this ad valorem taxes are nothing but which are based on the certain percentage of the output value. It means the tax is not fixed. In case of this specific tax, they are based on certain criteria. Criteria like what? Criteria like size, criteria like volume, or the criteria can be different. For example, usually in the case of vehicles, car also we have, if the length of the car is 4 meters, the tax applicable will be like this. If the length of the car is this much, the tax applicable will be like this. Similarly, in case of cigarettes also, if the length of the cigarette is this much, tax applicable is this much. If the length of the cigarette is this much, the tax applicable will be different. So on a specified criteria, you have to pay different taxes. So whatever will be the price of the raw material of this cigarette or of this car, the tax will be same. Suppose the raw material of this is a cigarette of one company and this is cigarette of second company. If the price of raw material is suppose 50 rupees, and in this case the price of raw material is 100 rupees, but both these companies, they have to pay same amount of tax, because the tax is being levied on a specific criteria, and that criteria is the length. But had these taxes on cigarettes been example of ad valorem taxes, so under this thing it is based on the percentage of the output. So in that case the output price is on 50 rupees, in this case it is 100 rupees, so the tax liability would have been different. But in case of specific taxes, it is based on a certain criteria. The specific tax, a very famous example of specific tax is, it is on the petrol and diesel. Because suppose in the international market, now petrol and diesel, they are not only an economic commodity, they are also a political commodity, at least in case of India. Because if the prices of petrol and diesel, they are increasing in the international market, so the government tax collection will increase if the taxes on petrol and diesel are based on this percentage of the output. So suppose in the international market the price of 1 liter of petrol is 50 rupees and the government is levying a tax that is based on 20% of 50, so the final price is 60 rupees. Suppose in international market the price is increased to 90 and now you have to pay 20% of 90. So the final price, the tax collection by the government has increased. Earlier it was 10 rupees, now it is 18 rupees. So in that case the final price will be more, it will be very high. So to resolve such problems, the government has decided that the taxes on petrol and diesel will be specific tax only, because in this case if the price becomes 90, so there is an option to the government that they can make their this type of tax to zero, because it is a specific tax. The tax is not dependent on the output, the value of the output. So this is the ad valorem tax and specific tax. Very famous example of specific tax is specific tax on the petroleum and diesel, the motor spirits. Then the next classification is tax on tax. Ideally from economics perspective, this classification divides into surcharge and cess. But the government has modified the usage of cess from tax on tax to some other thing. Tax on tax means these two things are common. It means suppose the corporate income tax is 30%. So on this 30% you have to pay this surcharge or cess. For example, the government says that you have to pay a surcharge of 5%. So 5% of 30%, which equals to 1.5%. So 30 plus 1.5, it makes 31.5%. And now on this 31.5% you have to pay this cess. It means both are tax on tax. The surcharge you are levying on this tax only, that tax is 30%. Cess also you are levying on this tax only. So ideally surcharge and cess both are tax on tax. But recently the government has changed the cess. We'll discuss later on. But the first common thing is both are tax on tax. So if both are tax on tax, what is the difference? The difference is cess is for a specified purpose. Whatever the purpose has been defined. For example, we have education cess 3%. So under that education cess of 3%, primary education is 2% and middle and upper education is 1%. So the government cannot use this 3% for anything else but education only. So CAG ensures that whatever money you are collecting, CAG will do the audit and they ensures that this 3% cannot be utilized for any other purpose but education. For example, in this budget, the government introduced Krishi Kalyan cess. So that Krishi Kalyan cess can be used only for agriculture, or that Swachh Bharat cess of 0.5%. So that can be used only for the purpose of Clean India or Swachh Bharat. But in case of surcharge, no such purpose is attached. So government will collect the money and government will use wherever the union government wants to use it. So this is not for specified purpose. The next difference is, or the next common thing is, both are not shared with the state government. On the recommendations of Finance Commission, you have to devolve certain amount of funds with the states, but this surcharge and cess, they are not a part of this devolution. So both are being kept with the union government only. That is why this is also some critics, they are saying that ideally this surcharge or cess, they are for a shorter duration of time, because if you want to improve the education, maybe for 10 years, 15 years, it should not be like the cess is continued from last 30 years, 40 years, 50 years. So whatever is the purpose, once that purpose has been achieved, it should be abolished. But because there is a personal stake of the union government, because they don't have to share this tax with the state government, that increases the fiscal space of the union government. That is why the union government is not proactive to abolish this surcharge as well as cess. On the other hand, they are increasing the type of cess and the type of surcharge. The surcharge and cess not being shared with the states by the union government. Then where this surcharge goes? The surcharge goes to Consolidated Fund of India. We discussed under the budget that we have three types of account being maintained by the union government. Consolidated Fund of India, then we have the Public Account Fund of India, and third one we have is the Contingency Fund of India. So surcharge directly goes to CFI. But in case of cess, it is outside Consolidated Fund of India. So a separate fund will be there for education. So cess will go to that particular specific fund. So it means automatically we also discussed that lapsable and non-lapsable fund. So suppose a fund you have created for education purpose by using this cess. So it will not be lapsed. Next year automatically it will be carry forward. So suppose in this year the total cess collection is 500 crore rupees and you are not able to utilize this 500 crore rupees. So whatever the remaining funds, maybe 50 crores, they will be automatically transferred to the next year. So cess is being maintained outside the Consolidated Fund of India. A separate fund will be there and for a specific purpose only you can use that cess. And in the constitution, surcharge is mentioned in article 271. There is no specific mentioning of cess in the constitution, but cess derives its power from article 270. But as such, like surcharge, nowhere cess is directly mentioned. But surcharge is directly mentioned under article 271, where it is written, to temporarily increase the tax revenue of the government can levy this surcharge. So this is what we have, surcharge and cess. But recently the government has changed the concept of cess. It's like in case of service tax, we'll discuss that service tax at present is 14%. So ideally the cess should be on this 14%, maybe 5% of 14%, 10% of 14%, but no, the government has directly said on this surcharge, on this service tax, there will be 0.5% of swach cess. It means it is not tax on tax, it is a direct value plus from this year a Krishi Kalyan cess will be applicable. So it means the government has modified the economic concept of cess. Now they are directly putting it 0.5%, 0.5%, 1%, 2%, whatever it is. Ideally the cess should be maybe 5% of 14% or 10% of 14% because the cess is tax on tax, but now the government has modified it. So this is what we have, the surcharge and cess. Next we'll discuss union taxes and states taxes being levied by states, as well as we'll discuss what is direct tax and different direct taxes that we have. So these are the taxes. So taxes can be levied by union government and taxes can be levied by the state government. So whatever is mentioned in this red ink is known as direct tax. Whatever is mentioned in this red ink is also an example of direct tax. Now direct taxes can be levied by union government like this, or direct taxes can be levied by the state government. But where it is mentioned, somewhere it should be mentioned that corporate income tax will be levied by union government. Otherwise, maybe from tomorrow the states can say, let's suppose this company Maruti has set up a new base in Gujarat, so now they have to pay tax to Gujarat government. So in the constitution itself it is mentioned under that schedule 7 we have 3 lists: union list, states list and concurrent list. So in that schedule 7 itself it is mentioned under that list. In list 1 it is mentioned that following items will be taxed by union government. Under schedule 2 it is mentioned following taxes will be levied by the state government. And because the residuary power is left with the union government, so suppose something was not mentioned in the constitution, while framing the constitution makers, they were not able to foresee that maybe in future after 50 years, 60 years, there can be some more type of tax which can come. Now because residuary power rests with the parliament or the union government, so residuary tax are being levied by the union government. The perfect example is service tax, we'll discuss later. So under this union government taxes, we have direct taxes mentioned here and indirect taxes mentioned here. Similarly, state government, direct taxes and indirect taxes. So these are the example of direct taxes. Individually we'll discuss, and these are the examples of indirect taxes. So under this direct taxes are further divided into two types: taxes on income and wealth we can say, and taxes on the property and the transactions related to property. So under this taxes on income, the first type of tax is personal income tax. So under that personal income tax, it is nothing but the individuals, me and you guys, we have to pay this personal income tax, also known as income tax. So suppose your income is 2.5 lakh rupees. So there are certain exemptions and deductions given by the government, because you have to confirm the horizontal equality, or you have to decrease that inequality. How you can do it? If your income is more, you should pay more tax. If your income is less, you should not pay any tax. So up to 2.5 lakh rupees, you don't have to pay any tax. And 2.5 to 5 lakh rupees, you have to pay 10%. 5 to 10 lakh rupees, it is 20%. More than 10 lakh rupees, it is 30%. And there will also be a surcharge if your income is more than 1 crore, if it is more than 1 crore, if your income is more than 1 crore, then you have to pay a surcharge of 10%. So this 10% of 30% will be there, because your tax liability is 30%, so 10% of 30%. So there will be a surcharge, this will be surcharge. But the government has given some deductions, some exemptions, because the government has to increase the savings of the India. So how to promote the savings? So to promote savings, you should give some income tax exemptions. Like what? If you are investing in some LIC, some insurance, you don't have to pay some tax. So a tax limit has been given that if you are investing in these specified ATC, ATD and all, if you are investing in this specified list up to 1.5 lakh rupees, you don't have to pay any tax. This is after this 2.5 lakh rupees. So if your income is 4 lakh, for example, if your income is 4 lakhs, up to 2.5, you don't have to pay any tax. The remaining 1.5 is there. Now you have two options. Either you will pay 10% of this 1.5 as the income tax, or you can invest this remaining 1.5 lakh rupees in that specified list and you can decrease your tax liability. Maybe you have invested in some mutual fund, or maybe you have invested in some insurance, some provident fund. So that comes under that exemption limit, or you have to pay income tax on this remaining 1.5 lakh rupees. The purpose of this creating all these incentives is to increase savings of the economy. So to incentivize the individuals or the society to increase the savings of the society. So this is what we have, the personal income tax. And then we have one more type of tax which is related to personal income tax, that is known as AMT, alternate minimum tax. And the value of this PIT, CIT and all we have already discussed. Rough value is 3.5 lakh crores. So this AMT we will discuss along with this MAT, minimum alternate tax. So this is what we have, the PIT. Again, PIT is based on the principle of ability to pay. Next is we are going to discuss corporate income tax. Just like individuals have to pay personal income tax, similarly companies have to pay corporate income tax. Suppose this is one company whose total income is 100 crore. The total money collected is 100 crore. Now this company must be involved in some business. So they have to pay for the raw materials and other administrative costs. For example, that raw material cost is 30 crore rupees. Then also this company has some employees, so the company has to pay salary of these employees. For example, there are only two employees, A and B, and to A this company is paying 5 crore rupees package, and to this person B this company is paying 2 lakh rupees. So now the remaining funds or the profit of this company is 100 crore minus 35 crores 2 lakh, or we can say 64 crores and 80 lakhs. This is what the profit. So on this 64 crore 80 lakh rupees, this company has to pay a proportional tax of 30%. So 30% of this will be the tax liability of this company. That is known as corporate income tax. The corporates has to pay some tax, and because the company has incurred some input cost, that is this raw material, so the company don't have to pay any tax on this raw material. The company also paid to the employees. So to this employee A, now this employee A will pay personal income tax on this 5 crore rupees. So some tax will be there as per the slab. More than 10 lakh rupees, it will be 30% plus some surcharge of 10% because the income is more than 1 crore. But this employee B don't have to pay any personal income tax, because up to 2.5 lakh rupees you don't have to pay any tax. So this is what the corporate income tax is. So this before 1990s the corporate income tax was very high. During that license Raj or Hindu rate of growth, everything was so much controlled. You have to take a license. During that era, in 1970s and 80s, if the company wants to start a business, maybe to make a TV, a radio, at the time nobody was allowed to make a radio. No company was allowed to manufacture radio. It was only under the government. So during that time the corporate income tax was very high. Now it is only 30% for Indian and 40% for foreign. At that time it was as high as 97%. So if the corporate income tax or the tax liability is very high, so it incentivizes the companies to hide, or we can say to evade the taxes. So they will hide it, or they will evade it. Hide also known as avoid it or hide it, whatever it is. So after 1990s, to increase the tax compliance as well as to incentivize the foreign investors to invest in India, because if in India the corporate income tax, suppose the CIT in India is 80%, the other alternative, for example, is some developed country, maybe USA, and in USA the corporate income tax is 30%. So more and more companies, they will open their branches in USA, and in India they will not open any branches. So during the course of time, India has decreased the corporate income tax after 1991 reforms for 2-3 purposes, mainly just like to increase the tax compliance or to incentivize the foreign investors to invest in India. Just like the government has given some exemptions under this personal income tax, similarly the government has given some exemptions to the companies. For example, some deductions. If you are giving to this much, Pradhan Mantri Relief Fund, for example, you don't have to pay any tax. Some is known as depreciation. For example, if in your company you are using some machinery, so it's not like if your income is 100 crore rupees and that's raw material that we discuss. So that raw material, there will be some depreciation of the machine. So that depreciation of machine will be counted whenever they are calculating your final income. So that 64 crore 80 lakh, that is after deducting that depreciation of the machinery. So all these exemptions, they are given by the government only. So when these exemptions are being given by the government, these exemptions can be misused. How this can be misused? For example, suppose there is one company whose profit is 10 crore. Now because there are some exemptions given by the government, so this company gave 9 crore rupees under exemptions. So finally the net tax liability, that is known as taxable income, becomes 1 crore, and 30% of this 1 crore equals to 30 lakhs this company paid as tax, and this is 100% legal because this exemption is being given by the government only. So 10 crore rupees is the profit, but this company is paying only 30 lakh rupees. So it is a legal loophole. So to stop this legal loophole, the government started with the new concept that is known as minimum alternate tax. So what this minimum alternate tax is, that government don't care whatever you are paying under these exemptions, whether you are paying 5 crore, 10 crore, 7 crore, whatever the amount is, you have to pay either CIT. So CIT in this example is 30% of 10 crore, which equals to 3 crore, or you have to pay a minimum alternate tax. The present value of minimum alternate tax is 18.5% of this book profit. This is known as book profit. So the government said whatever exemption you are giving, whatever amount of money you want to give to under this depreciation, deductions, exemptions and all these things, either you have to pay this 3 crore rupees or this minimum alternate, that is 1.85 crore. So this system, this minimum alternate tax was started in 96-97 budget. This is what we have, the minimum alternate tax. So either a company is paying corporate income tax or minimum alternate tax, not both. So ideally the question comes, why don't all companies pay minimum alternate tax? Because the list of exemptions and deductions is not too much. Whenever a company files the tax under minimum alternate tax, there is a lot of scrutiny being done by the corporate, by the income tax officers. So they don't want to take a risk. And the secondly, this depreciations or deductions is not available to all the companies. Now the government has also given some exemptions to this MAT also. It's not like each and everybody has to pay this 18.5%. The government has given some exemption, maybe to these power sector companies where the depreciation is very high, some infrastructure companies. So the government has said that this MAT will be applicable on all the companies except a small list, but otherwise you have to pay this minimum alternate tax. Just like these corporates, they are decreasing their tax liability using legal loopholes. Similarly, the individuals can also decrease their liability by using some legal loopholes. So in that case, the individuals have to pay alternate minimum tax, that is AMT. If your income is more than 20 lakh rupees and your tax liability is less, in that case you have to pay the same 18.5% of book profit as the alternate minimum tax. But this is applicable, AMT is applicable only for individuals whose income is more than 20 lakh rupees. So just like in case of corporates we have minimum alternate tax, similarly in case of individuals we have alternate minimum tax. So this is what we have, PIT and CIT. The collection of CIT is more than 5 lakh crores roughly. In case of PIT, the collection is 3.5 lakh crores. Then we have that interest tax. So this interest tax, it was applicable only on the credit institutions. Credit institutions means banks, financial institutions, financial companies that we have. So they have to pay this interest tax, and the value of that interest tax was 2%. So 2% of the total interest which was being collected by these credit institutions, accrued by these credit institutions, 2% of that interest they were supposed to pay as tax, and that tax was known as interest tax. Why I have crossed this interest, expenditure, fringe benefit, estate, wealth and gift taxes? Because these tax has been abolished. Right now we don't have any interest tax, expenditure tax, fringe benefit, wealth, estate and gift tax. But as concept they still exist. That is why we are discussing these taxes. And why the government abolished it? The government abolished this interest tax in 2000. And why they abolished it? When a tax becomes viable, it becomes viable if the collection, the amount of money which you are collecting is much more than the administrative cost. In 2000, the interest tax, the value of interest tax was only 1000 crore. Now compare these things with this PIT, 3.5 lakh crores, CIT 5 lakh crores. The government is getting only 1000 crore rupees in the form of interest tax. So the administrative cost was high, the collection was less. So in 2000 the government decided to abolish this interest tax. So right now we don't have any interest tax. Then we have the expenditure tax. Earlier we had this expenditure tax. Expenditure tax was there. Suppose you are staying in some hotel or you are consuming a food from an air conditioner restaurant. So at that time earlier you were supposed to pay this expenditure tax if the income if the one time expenditure was more than 400 rupees. So at that time you were supposed to pay this expenditure tax. So all these taxes were there when there was no service tax. When the service tax started in 94-95, afterwards the relevance of all these taxes, expenditure and all has decreased. So right now we don't have any expenditure tax. Then we have fringe benefit tax. So firstly, what is fringe benefit? Fringe benefit is, suppose you are working with a company, Infosys, and this Infosys is not paying you in cash but giving you some services or some benefits like free meal, transportation free, some coupons. So non-monetary benefits this company is giving you. So these are known as fringe benefits. So this fringe benefit is not on the income, because fringe benefit tax, which has now been abolished in 2009, earlier this fringe benefit tax was on the expenditure and not on the income. So it was borne by Infosys and not by the employee who was getting all these fringe benefits. So if somebody is saying direct taxes is on income and wealth of individuals and firms, so that is technically a wrong statement, because it is on income as well as expenditure by individuals and firms. So fringe benefit tax is on the expenditure side. Then we have the dividend distribution tax. Dividend distribution is, we'll discuss in detail what is dividend and all under that securities chapter, or maybe under that capital market. In the share market we'll discuss what is dividend means. So suppose one company is there and company has diluted 10% of the ownership, and these individuals A, B, C, D and E, they have purchased the shares. So what this A, B, C, D will get in return? They will get the ownership of this company as well as dividend. So dividend is nothing but it is a certain percentage of the profit. So suppose this company is getting a profit of 10 crore rupees and the management decided that out of this 10 crore rupees we will distribute 1 crore as the dividend among the shareholders. So this each individual will get 20 lakh rupees as the dividend, and this company for example is Superprofs. So the dividend distribution tax is being paid by Superprofs and not these individuals A, B, C, D, E. The present value of dividend distribution tax is 15%. So when this company is giving, or distributing the dividend, this company has to pay 15% as the dividend distribution tax, because that is not a part of our example at 64 crore 80 lakh. This 1 crore, suppose you want to distribute 1 crore, this 1 crore will be subtracted from that net profit. So it will not be 64 crore and 80 lakhs, because 1 crore you have distributed among the shareholders. So your tax liability will be 63 crore and 80 lakh rupees. So now on this 63 crore 80 lakh rupees, you have to pay 30%, and on this 1 crore rupees you have to pay 15%. This is what the dividend distribution tax is. Next, under that, taxes on property. So first, under direct taxes of union government we discussed taxes on income, and then second we will discuss the taxes on the property and the transactions related to property. So under this, first one we have is wealth tax. If suppose you have your wealth is 30 lakh rupees, I have 30 lakh equivalent wealth. This wealth means maybe you have gold, maybe you have some house, some residential building, you have some guest house. All these are regarded as wealth, or we can say assets. So if your wealth is more than 30 lakh rupees, earlier you had to pay 1% of this wealth as tax every year. But because there is a lot of black money in India, so it is very, very difficult for the government to actually come up with the statistics which are related to this wealth tax. So again, the administrative cost was very high. So finally last year in 2015-16, the government decided to abolish it, because the money, the tax which was coming to the government was only 1000 crore. Think about the country like India, where the scam, the coal scam is of, or the spectrum scam is of 1.7 lakh crores. The country where the scam is of 1.7 lakh crores, such an astonishing figure, the full country is paying a wealth tax of only 1000 crore. It means the administrative cost was very high and the tax collection was less. So the government abolished this wealth tax from budget 2015-16, and it has replaced this thing with a surcharge. And where it will be levied? Because wealth related to wealthy individuals only. So earlier just we discussed, if your income is more than 1 crore rupees, you had to pay 10% as surcharge. So 2% extra added. So it means after abolishing wealth tax, now the government decided that this surcharge will be 12% if your income is more than 1 crore rupees. By adding this new surcharge of 2%, the government estimated that the increase in the tax collection will be of 10,000 crore. So earlier government was getting 1000 crore, but now the government will get 10,000 crore rupees by putting this 2% extra surcharge on these wealthy individuals and firms also. So this is what we have, the wealth tax. At present, no wealth tax, abolished. Then we have the estate duty. Estate duty means by transferring of wealth to the legal heirs. Suppose your grandfather or your grandfather, they want to transfer their wealth to your name. So at that time they have to pay some tax. But estate duty, again the value of estate duty was very less. Can you give me a rough value? What was the value of estate duty? The value of estate duty was just 15 crore when it was abolished, and it was abolished in 1985. So in 1985 the government was getting only 15 crore from the estate duty. Again the administrative cost was very high, so the government decided finally to remove this or to abolish this estate duty. So what is estate duty? When you are transferring of wealth to the legal heirs from the grandfather to the grandson or father to the son, at the time of transferring of wealth you have to pay some tax, that was known as estate duty. Now comes the gift tax. So gift tax was the only remaining tax, because if you have 30 lakh rupees What options you have? Either you will pay wealth tax if you don't want to transfer these 30 lakh rupees. The second option is you can transfer it to your legal heirs. So if you will transfer, you have to pay estate duty, or you are paying estate duty. Now the third option was wealth tax, or you will transfer it, or you will do the expenditure. So at that time you have to pay expenditure tax. But one more loophole was there. That loophole was, either you will keep this 30 lakh rupees with yourself, at that time you have to pay wealth tax, or you can transfer to your grandson, at that time you have to pay estate duty, or you can consume this 30 lakh rupees, in that case you have to give expenditure tax. One legal loophole was you can gift it. Rather than transferring this thing, you can gift it to your friend or maybe some family member. So this was the legal loophole. So to stop this legal loophole, the government applied this gift tax also. So when they abolished these taxes, the government also abolished that gift tax. Earlier, the gift tax was on the donor. Whoever was giving that particular gift, then they amended it and finally made it to the donee, whoever is collecting that particular gift. And now after 1998, the government finally has abolished this gift tax, and right now we don't have any gift tax, because whatever gift you are getting, that will be added in your personal income. So suppose somebody is there, A is there, and A is getting a gift of 1 lakh rupees. So this 1 lakh rupees will be added in the income of A, and that will come under the slab system of personal income tax, 10%, 20%, 30%, or whatever it is. Then we have the stamp duties on financial documents. So financial documents, stamp duty, just like few examples is securities transaction tax. Securities transaction tax, also known as STT. So whenever you are buying a share, for example, this company is there, this company is diluting the share, and A wants to purchase few shares. So during purchase of these shares, you have to pay STT, Securities Transaction Tax. So on financial documents, this stamp duties is being paid on financial documents as well as other assets also. But only in case of financial document, it is being levied by union government. For other stamp duties, it comes under state government. But on financial document, it is being levied by the union government. The next tax on the property, or next direct tax that comes under union government, is taxes which are being levied on the sale and purchase of newspaper and advertisements therein. Whatever advertisements we have on that, the Hindu pages, first page, second page, third page, all these advertisements, sale and purchase, you have to pay some tax. That tax is being levied by union government. Then we have the terminal taxes. Terminal taxes, they are like the platform tickets and all these things. So now the most of these terminal taxes, they are being abolished and they are being added to your base fare. So suppose you are booking a ticket of 500 rupees. So that 500 also includes this terminal taxes, and if they are not being added to this terminal taxes, they are being given as a grants. So union government will collect, will keep it, and they will give in the form of grants to the states. And then we have CST. CST is nothing but Central Sales Tax. We have a CST Act also in 1950s. So suppose this is one state, Maharashtra, and Maharashtra is producing this pen. So when this pen is being produced, whoever is the manufacturer, this manufacturer first has to pay excise duty. Then suppose this manufacturer wants to sell in some other state, maybe Sikkim. So transportation is going to take place. So when this particular product crosses the border of Maharashtra, at that time you have to pay some tax. That tax is known as Central Sales Tax. Central government is levying the sales tax because the sales tax is the domain of the state government. But in case of interstate trade, this is an example of interstate trade. Had this been within Maharashtra, if the manufacturer wants to sell within Maharashtra, no CST will be there, only sales tax will be there. But in this case, this manufacturer has to pay this CST also, that is central sales tax. So this CST is being levied by union government, collected by union government, but it is being transferred to Maharashtra. That is why article number 269 of the Constitution says this thing, that these are the taxes which are levied. It means the authority levied and collected by union but used or appropriated by the states. So these are the taxes which are being levied and collected by union government, but they are used by the states. So these three taxes, taxes on sale and purchase of newspaper and advertisements therein, terminal taxes and passenger taxes plus CST, these three taxes, they are being levied by union government, collected also by the union government, but used by the states. Then we have the indirect taxes which are being levied by union government. So first the definition of indirect taxes. Indirect taxes are nothing but the indirect taxes are taxes on the commodities and services. So if any goods are there, so you have to pay some tax, or if some service is there, you also have to pay some tax. Sorry. First we will discuss custom duty. So what custom duty means? Whenever you are importing something from outside India, custom duty will be levied. So whenever the international border, trade across this international border is going to take place, the government is going to levy this custom duty. So this custom duty, from the economics perspective, it is applicable on both exports as well as import. But because if government will levy custom duty on export also, that is going to increase the prices of our commodities, and if prices will be increased, they will not be competitive in the international market. That is why in India we don't have any export duty for few products, and that is for a certain specified time only the government levies this export duty. For example, if the export of sugar increases, so the prices of the sugar in India is going to increase because the availability of sugar within India is going to decrease. If within India the sugar availability is decreasing, the prices are increasing, and the reason is because we are exporting the sugar. So what the government will do? The government will levy some export duty so that the prices of Indian sugar in international market increases, which makes Indian sugar less competitive, which decreases the demand of Indian sugar in the international market, and which ultimately increases the supply of Indian sugar within India. So that is what very exceptional times, and that is for a short duration only, the government levies this export duty. Otherwise in India there is no export duty, or in case of custom duty, no tax is being levied on export. The only tax is on the import. So first of all there will be basic custom duty. Then after this basic custom duty, there will be one more thing, that is known as countervailing duty, CVD, also known as additional custom duty. This CVD is being levied to compensate two things. First thing is, because you are not producing this pen within India, so there is a loss of excise duty to the government, because this pen is not being manufactured in India, so there is a loss of excise duty. So first, to compensate the excise duty, Second, suppose you are importing this pen from Germany and the cost of production of this pen is 50 rupees, but German government is giving a subsidy of 10 rupees for this pen. So finally the market price of this pen is 40 rupees. Within India also there are few manufacturers of this pen, but Indian government is not giving any subsidy. So it means there will be more and more import of this German pens, because in India the market price is 50 rupees and when we are importing the price becomes 40 rupees. So as a consumer, we don't think whoever is manufacturing, what we care about is the quality as well as the price. So to offset the subsidy given by other government, Union government is going to levy a countervailing duty of 10 rupees. So when a countervailing duty of 10 rupees will be levied, we are importing at 40 rupees, 10 rupees will go to government and the market price in India will become again 50 rupees. So not to negatively affect our domestic manufacturers, the government levies this countervailing duty for two things. First one is to offset the excise duty and the second one is to offset the subsidy. Then after this countervailing duty, there is one more type of tax, that is known as SAD, special additional duty. We discussed if you are transferring the goods from Maharashtra to Sikkim, you have to pay some tax, that is known as central sales tax. But in this case there is no central sales tax. So to offset or to equalize with the within India trade, because within India you are trading within Maharashtra to Sikkim, similarly here also you are trading from outside India to this particular state. So this SAD will be applicable. SAD value is present 4%, just 4% is for central sales tax, for resale of central sales tax. So under SAD will be to offset the impact of central sales tax. A special type of duty will be levied, that is known as SAD, special additional duty. Then we have one more thing in specific cases, that is known as anti-dumping. That is not always, but anti-dumping duty will be levied. Now what is anti-dumping is, suppose we'll go with the same example. In Germany, this pen is available in 40 rupees because the government is giving some subsidy. But the government is again giving one more type of subsidy of 10 rupees when they are exporting it. So to India it is available in 30 rupees. But in German market it is available in 40 rupees. It simply means the German government or this German company wants to dump its products in India, and when they will dump at this 30 rupees, domestic manufacturers of this pen, they will be wiped out maybe in 1 year, 6 months or 3 months, because they cannot afford this 20 rupees subsidy. The government is not giving subsidy, there will be loss, because as a consumer we will consume these pens because this pen is available in 30 rupees, Indian manufacturer pen is available in 50 rupees, so we will buy this pen only. And there is a difference between the price of this pen in the domestic market of Germany and the price at which they are exporting it. So whenever there is a difference, the domestic manufacturer, they will go to the Ministry of Finance and they will say such amount of dumping is being done, and at that time the government will levy this anti-dumping duty. In this example it will be of 10 rupees. So this is what we have, the anti-dumping duty. And at last of course cess will be there. So these are the taxes which are involved when you are importing any commodity, and this is what we have, the custom duty. From economics perspective it is being levied on both export as well as import, but in India it is being levied only on the import of commodities, because otherwise if we will levy custom duty on export also, they will make our Indian products uncompetitive. Then we have the excise duty. Excise duty, we discussed that it is being levied on the production of goods. Now goods is one thing and services is the second thing. Services means, suppose we are discussing something It means Superpros is giving you some services by recording these lectures, by giving you these lectures. So this is the type of service. Suppose you visit some saloon to take some haircut. So that saloon, that person is giving you a service. You are not buying any goods from the saloon, but you are taking only the, you are using only the services. So that service and all this concept came after 1970s and 80s and 90s. So finally the India also realized that there should, these services which you are consuming, they should be taxed. So finally in 94, the government, now because the residuary power lies with the union government, so union government came up with this service tax, and this tax has increased drastically. In 94, the collection was just 400 crore rupees, and in 2016 the collection is 2.3 lakh crores. See the difference. In 1994, the service tax was being levied only on 3 services. Only 3 services, and that too at the rate of 5%. These 3 services were telecommunication, share trading, and the third one was insurance sector. And now how many services comes under this service tax? I'll give you 4 options: 10, 20, 30 or 100. So the answer is, we have a negative list concept. This negative list concept means the government said service tax is not being levied on these 17 items, and for all the rest of the items service tax will be levied. So this is known as the negative list concept, under which the government will specify that this tax will not be levied on these items, except these items the service tax will be levied on all the items. So now we have a negative list concept in case of this service tax, and it has increased drastically. Next we will discuss and we already discussed the present value of service tax is 15%. 14% plus 0.5% as Swachh Bharat says, and 0.5% recently added on 1st June 2016, it will be Krishi Kalyan cess. So these are the taxes of the union government. Then we will discuss the taxes of the state government. So again, state government taxes on direct taxes. So under the direct taxes, 2 parts: taxes on income, taxes on property, and transactions of property. So under this taxes on income, first we have is agriculture income, but the value of agriculture income is less than even 500 crore, because Indian agriculture is not that rich. Indian farmers are regarded as the poorest section, poorest strata of the society, and agriculture is a state subject. So in few states we have that taxes on agriculture income. So combined to these 29 states, the total agriculture tax that is being collected by the government is 500 crore only. Then we have the professional income. In case of this professional income, the tax collection is 5,000 crore, slightly more than 5,000 crore. What is professional taxes? Professional tax, the professionals like engineers, doctors and all, every year they have to pay 2,500 rupees tax, irrespective of their income. It means professional tax is an example of proportional tax. Not even proportional tax, it is a fixed tax. Whatever your income, suppose you are an engineer and your income or salary is 50 lakh rupees, and one more engineer is there whose salary is 10 lakh rupees. So 10 lakh or 50 lakh, they have to pay fixed amount of professional tax, that is 2,500. Now the 14th Finance Commission recommended to increase it to 12,000. But at present, because this tax is being levied by the state, so it is the discretion of the state. So at present it is 2,500 rupees. Then we have the taxes on property or the direct taxes on property. We have land revenue. So land revenue tax is being levied by the states, and the rough value of land revenue tax is 12,000 crore. Then we have the registration and stamps. Whenever you want to register something, transfer of properties and all at the state level. So this is a major type of tax, 1 lakh crore. We already discussed that revenue receipt part of the states, and the value was 18 lakh crores. Out of this 18 lakh crore, we had that tax and non-tax. Under this tax, we discuss about the state's own resources, and from the center, from the union government, from the state's own resources, the value was 8 lakh crore. So out of this 8 lakh crore, if the states are getting 1 lakh crore from some only one type of tax, so it means it is a big figure. So states are getting a lot of tax from this registrations and stamps, and the other major source is this sales tax, more than 5 lakh crore. The last one is taxes on urban immovable property. Now in certain states they have devolved this power to the Panchayati Raj institutions or municipalities, but in majority of the states it is being levied by the state government only. Then we have the taxes on commodities and services. So whatever you are producing, on the production, union government is going to levy the tax, and on distribution, states are going to levy the tax. So this sales tax, once this pen is being manufactured, now you have to sell it. So while selling purpose, you have to distribute it. So at that time, states are going to levy some tax. Anyways, so this is what we have, sales tax. Then we have the motor vehicle tax. So whenever you are going to purchase a vehicle from any state, you have to pay some tax, that is known as motor vehicle tax. Then we have the electricity tax or electricity duty. Again, electricity is a state subject. Water is also a state subject. So electricity duty, water duties, all these things is being levied by the state government. Then we have the entertainment tax. You know this entertainment tax, suppose some movie came, Bhag Milka Bhag came, and this UP government decided that no entertainment tax will be levied on that particular movie. So this entertainment tax is being levied by the state government. So in economics, few things you have to relate to the present circumstances, otherwise these things are a little bit confusing. Then we have the state excise. This state excise means excise duty on liquor, opium, etc. So whenever there will be a production or purchase, so if this something is being produced within the state or you are purchasing it from outside the state, states are going to levy this excise duty, and this excise duty will be on this liquors, opiums, etc. Then we have the other stamp duties. So this other stamp duties means stamp duties except this financial documents, they are being levied by the state government. But now this state excise duty and other stamp duties, they are a special type of tax which comes under state government, and under article 268 it is mentioned that they are only levied by union but collected and used or appropriated by the states. So these three taxes, they are being levied and collected both by the center but used by the states. But here in case of this state excise duties on liquor, opium, etc. and these other stamp duties, they are only levied by union. And the constitution gave this power to the union, but they are being collected by the states and being used by the respective states only. So this is what we have, article 268 and 269. We will revise all these articles from 265 to 293 in the last lecture. And then the recent trends. Next we will discuss the last topic of today's lecture, that is the recent trend. Recent trend in the sense the relation between direct taxes and indirect taxes, whether the direct tax is more or the indirect tax is more, and which one should ideally be more. So we'll compare 2-3 years, 1950, 51, then we'll compare 91, 2000 and 2016 we'll compare. So in 1950-51 it was 36%. So direct tax was contributing 36% and indirect tax was contributing 64%. Before going into this detail, first tell me, ideally direct tax should be more or indirect tax should be more? Ideally indirect tax should be less and direct tax should be more, because we discussed direct tax is based on the principle of ability to pay. It means rich are paying more. And in case of indirect tax, it is regressive in nature. Everybody has to pay the same tax. So that is why indirect taxes should be less in any economy. The percentage of indirect taxes should be less and the percentage of direct taxes should be more. But by 1991, this share has become 16%. It was less and it decreased further. Why it decreased further? Because during the 50s, 60s, 70s and 80s decade, there was a license raj in India. All these companies, they were directly responsible to the government, or these companies, they belongs to the government. So whenever a company belongs to the government, to take an excise duty or forcing this company to pay excise duty or the administrative cost involved is less in comparison to collecting the tax from the individuals. Maybe me and you, we can use some legal loopholes to hide our income. Now we forgot two definitions: evasion versus avoidance. Avoidance means using some legal loophole, you are decreasing your tax liability. We discussed that exemptions, deductions given by the government and in case of corporate income tax. So this is known as the avoidance. Evasion is illegal. You are intentionally under-reporting your income. That is known as evasion of taxes. So evasion is illegal, avoidance is legal. Both are decreasing the tax liability. This you are decreasing the tax liability by using illegal means. This you are decreasing the tax liability by using some legal means. So in case of direct taxes, the tax avoidance rate can be very high. The tax evasion also is very high. But in case of this indirect taxes, if the company themselves belongs to the government, so government was in very good position to levy more and more taxes, but indirect taxes are regressive. So it increased to 84%, then it became 37%, and finally at present it is 55%. This actually changed in 2007. Till 2007, indirect tax was more than the direct tax. After 2007, the direct tax is more than the indirect taxes. So this is what we have, few basic concepts which are related to taxation. Now in the next lecture, we will discuss about the application part. First we will discuss the relevant articles in the constitution which are related to the center-state relations. And once this center-state or the fiscal federalism will be over, under which we will discuss these articles as well as the 14th Finance Commission or Finance Commission recommendations. After covering in the next lecture, maybe in next to next lecture, we will discuss the tax reforms. We will discuss the Chillaiya Committee recommendations. Then we will discuss the GST bill, what is the VAT, what is GST, and then maybe we will discuss the insolvency bill that came recently. So thanks a lot.